So we're taking the conversation to the Market Street. Tajuddin Ibrahim is the head of research at Chapel Hill, Denham, and he's live to us from the Stock Exchange trading floor. Good morning, Tajuddin. It's good to have you here.
Good morning, Bosi.
Great. Thanks for coming through. This is a very interesting time in which the dynamics of the market seems to be changing, and I'm sure you folks are not missing this at Chapel Hill, Denham, as a securities trading firm, as an investment bank, and all of that. So I'm sure you guys have all of this in your crosshairs. So give us your take on the recent, on the current market rebalancing kind of from the fixed income side to equities.
Okay, so thank you, Basil, for that. What has really happened in the market is partly regulation-driven and also partly driven by corporate actions of companies. So what we have seen from the fixed income, or let me say money market standpoint, we have seen yields moderate significantly, and that moderation has largely been driven by the regulation of the money market by the CBN. Restructured the OMO market. We now have fewer players, being able to play in the OMO market. Largely speaking, financial institutions that are non-banks have been taken out of the market. So that development resulted in sustained moderation in yields on money market instruments, and then there was like a knock-on effect on the bond market as well. So we've seen yields moderated significantly as well. So the question now is, how has this impacted on the stock market, or let me say on equities? This has been positive for equities because some billions of naira that were not rolled over in OMO instruments are finding their ways into the equities market to take position in selected stocks. And that, largely speaking, drove or has been the driver of the about 10% year-to-date appreciation that we have seen on the NSE All-Share Index on a year-to-date basis. Apart from that regulation by the CBN, there's also been some announcements. There have been announcements by companies such as Dangote Cement trying to buy back their own shares, such as MTN now having the Attorney General of the Federation withdrawing from a court case that they had charged them about earlier on last year. So that also, those two news flows also supported the movement of those two stocks, and to some extent, the entire market. The third element that has been driving the stock exchange performance this year are corporate dividends that investors are expecting that companies are going to pay. Talking here about final dividends for top companies that always pay dividends. So those are the drivers of the fixed income, money market, and the equities market on a year-to-date basis, Barson.
Yes, Tajuddin, so where are pension fund managers in this entire conversation? Folks are asking if the yield curve at the money markets, debt market, treasury bonds, and all that are good enough for pension fund managers looking at a resurgence of a very positive doing at the Nigerian stock market on the equity side. What are you learning? What do you know?
Okay, so pension fund managers in the country have been doing some sort of rebalancing or asset allocation to look more into equities, given what I have said earlier around yields in the market falling on both short and long-dated instruments. So what they are doing now is they are positioning in other instruments, such as corporate bonds, and also such as commercial papers issued by companies. And at the same time, some of them are increasing their allocation to equities. because of that development in the money market where yields are falling materially. And so our expectation at Chapel Hill Denham also is that we expect some of these pension fund managers to take a look at structured products such as Chapel Hill Denham's Nigeria Infrastructure Debt Fund, a fund that is debt-based but operates in terms of equities, in the sense that that fund makes distribution to investors on a quarterly basis. So that fund and some other funds in the market are where we expect the PFAs to continue to take a look at for as long as yields are falling in the money and bond markets.
So interesting if you look at what the pension funds are doing. But again, 2 days ago, you sent out a note regarding the premium stock index. So let's talk a little bit more about the big boys or some of the stocks you have in that premium stock index that are there. So talk to us. This index is up nearly 20% since 2020 started. It's a roller coaster to start a new year. What's your take on this sector? And why should I invest in it?
Yes, you are very correct. You are very correct that the index is up, about 18.5% on a year-to-date basis. And I think that is very positive, and it sends early signal around market recovery in 2020. We're in January, and that index has been up by about 18.5% or thereabouts, and that is ahead of the entire market that is up by about 10%. To my mind, the movement of that index speaks to a couple of factors. Number one of them is it speaks to quality, because the constituents of the premium index are quality stocks. Number one of them, we are talking about MTN, Dangote Cement, Zenith Bank, UBA, Lafarge Africa, Access Bank, and Seplat. These 7 stocks I have mentioned have performed materially well so far this year, with the exception of Seplat, which is still a laggard, and we believe at some points there will be a repricing. But we are a lot positive on MTN because of the strong expected cash flows, the strong expected dividends, as well as the development that we've seen so far around the Attorney General of the Federation's case, the withdrawal of that court case. The second factor or stock for consideration in my mind in that premium index is Dangote Cement, largely speaking because of the share buyback program that the company is planning to embark on. So the company have said they are looking to buy back some of their shares, and to my mind, companies buy back their shares when they consider the shares to be significantly undervalued. And that is the case for, that knows to be favorable. Dangote Cement has moved up by about 21% since the beginning of this year. And we expect a bit of more rally, if they release their full year results for 2019. We like the banking stocks in that space. We like Zenith Bank, largely because of the earnings quality. The asset quality is high, and we see little or no risk to the NPL ratio for Zenith Bank. Another compelling stock in that space also is GT Bank. If you notice, if you watch around, you will see that GT Bank has cut down on their interest rates to the retail segment of the market. They've brought down their retail loan rates to about 16% from about 21% recently. So what that speaks to us about is expectations around increased volumes in terms of giving out retail loans to consumers, and we expect that in the next couple of quarters, the result of those loans will begin to show on their earnings, and then investors will probably see stronger earnings from GT Bank as they penetrate further into the retail segment of the market. Lafarge Africa is another interesting stock in that space because of the strong positioning in the industry, also likely because of the ability for them to manage costs by utilizing what we call alternative source of energy instead of using gas or instead of using LPFO. So those are the reasons that we like all those stocks. And interestingly, the market has been largely favorable to them in terms of share price appreciation on a year-to-date basis. Boasen.
Okay, so let's change tack a bit and talk about the debt market, non-sovereign, typically speaking, subnational. Lagos State just closing shop on its 100 billion naira infrastructure bond, and then your NIDF, I think about 15.52 billion naira infrastructure fund is also still on the street, still open there for investors. Take us through why these bonds are very good at this point in time, considering the current yield curve environment, and if this is good in view of inflation, interest rates, environment, and all of that.
Okay, so if we look at the bond market as we speak, I think we should probably start from the regulator here talking about the DMO and also the federal government in this case. So the communication that we have gotten from the federal government is that they will issue less bonds this year compared to last year. This year, for instance, they plan to issue about 1.3 trillion in bonds. And out of that 1.3 trillion, the expectation is that they will accelerate the issuance of bonds in the first half of the year, and some of the other parts of it will come much later in the second half of the year. In the first half of the year, for instance, we're expecting them to issue about 840 billion naira in FGM bonds based on the communication that they made to the market about a couple of days ago. So what we expect in that space is sustained decline to some extent in yields, largely because of the low volumes of bond issuance that is expected to flow into the market. So we could see a bit of like maybe 20 to 50 bips moderation in some instruments in that space, but not more than 50 bips because we have seen substantial moderation in yields in that space. But what I think is probably important to talk about is a possible repricing of yields in the second half of 2020. So far, we have seen a moderation, but in the second half of 2020, we believe there will be a repricing of yields, largely because of three factors. Number one of them is a possible repricing around the movement in inflation. We have seen inflation, going higher, and we have negative real yields on some instruments as we speak. The second factor is around the current account balance of the country. We are in the deficit as we speak. So that means that at some point we will need some foreign inflows to support our FX or our ability to fund our imports. So in funding your import, largely speaking as a country, we utilize FPIs, and those FPIs are unlikely to return or come to the market aggressively if yields are still subdued. So this is partly why we think there will be a correction in yields in the second half of the year. But as we speak, we think investors should take a look at NIDF, which is the Nigeria Infrastructure Debt Fund that we are selling at that we are managing at Chapel Hill, Denham. And the idea around that is for them to be able to generate stronger yields on their investment compared to what they will get when investing in bonds, in FGM bonds. So we see that instrument as one of the most compelling instruments in the market as we speak. And we are in the market as we speak. We are in the market with a 15 billion naira issuance. So we encourage PFAs to take a look at that instrument. We've seen a couple of them buying into it, and we expect more inflows from them.
Tajuddin Ibrahim, Head Research at Chapel Hill, Denham. Thank you so much. We appreciate your time this morning taking us through the marketplace.